Welcome to Atcons, the easiest way to explore your journey of investing in stock market.
Net profit. Net profit is the distributable profit available as surplus. Net profit is the bottom line for every business, the source both of today's rewards, dividends, tomorrow's rewards like bonus shares for its equity holders. Net profit is the profit derived after deducting interest, depreciation, and taxes. NP is equal to sales minus expenditure plus interest plus depreciation plus tax. NP is equal to GP minus depreciation plus tax. The higher net profit is the better and growth oriented. Dividend to yield ratio. There is no use for having a zero yielding companies in one's portfolio. A profit-making company transfers a certain percentage of its net profits to reserves while the balances are paid out as dividends to shareholders. The payout ratio indicates the percentage of earnings paid in the form of dividends to shareholders. Many investors show a marked preference for a company with an attractive payout ratio. On the other hand, a company which does not plow back enough profits into reserves cannot impress into growth. A proper balance should be struck between the current need for dividends and future need of funds for growth. A dividend warrant is the most important part as equity investor books forward every year. Dividend issued from net profits. Some companies prefer to pay interim dividends and final dividends. A higher dividend paying company is investor attractive one. Investors are not really interested in dividends but in the relationship that dividends bear to the market price of the company's share. The relationship is best expressed by the ratio called yield. Yield is equal to dividend per share multiplied by 100 divided by market price per share. Yield indicates the percentage of return that one can expect by the way of dividends on the investment made at the prevailing market price. Generally, finance companies are yield oriented. That is, say, high dividends paid at low market price. Price earning ratio. The price earning ratio expresses the relationship between the market price and its earning per share. PE is equal to market price divided by EPS. If PE ratio is 10, it means an investor pays 10 times price than its annual earnings. If one assumes EPS is constant, it will take 10 years to recover the price by way of earning dividends from the company. But really, it is not so. The company's EPS changes from time to time. PE ratio is the reflection of market opinion of earning capacity and future business prospects of the company. Generally, EPS will vary steadily, but PE ratio will fluctuate 3 to 50 times high, which often creates confusion to investors. There is an opinion in between investor community that high PE ratio companies have low risk. We cannot fully rely on that. In fundamental analysis, when a company's earning increases, then PE ratio come down. A fundamental analyst then says it is underpriced. He compares the same with the industry average PE. Say if an industry aggregate PE ratio is 40 and the particular company PE ratio 5, then the analysts say that the company is 40 divided by 5 is equal to 8 times underpriced. But in real sense, there is no condition for 8 times appreciation. Generally, PE ratio above 3 and below 15 may give a better safe investment opportunity. One may add more for track record promoters like Tatas, Birlas and Ambanis. Conclusion: generally, high PE ratio industry is low risky.
PE ratio is the measure of confidence of investors to that particular industry. So select a high PE ratio industry and select a low PE ratio company in the group so that you can get a underpriced company in that group. Please watch the next video for continued information related to the same topic. Share your thoughts about this video in the comments section. Thank you for watching the video and staying connected with us. Keep practicing, keep learning, keep growing.